Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger Associates Financial Planning. I'm pleased to have Kyle Ryan, who is also a CFP as well as a chartered financial consultant, joining me today. Kyle is one of my associates and also one of the partner equity owners of the firm. Thank you for joining me, Kyle.
Thanks for having me.
So this is part six?
Seven.
Holy smokes, we're on seven already. This is part 7 of a series where what we did is we went through artificial intelligence, ChatGPT or something. Okay, somebody printed out a whole list of questions that were pertaining to different topics within financial planning. And while we didn't necessarily follow the same, cash management, tax planning, risk management, investment planning, retirement planning, estate planning, we followed sort of a format that made sense because it flowed. So first episode was on just general financial planning questions. And then we went into debt management, retirement planning, risk management. Then we went into, what was the first one we did a couple weeks ago? Investments were the last two. Oh yeah, investments were the last two. So the last question that came up was a perfect lead in to this week's topic. This week's topic is tax planning, but driven more towards the investments. And interestingly, we reviewed the questions right before we sat down to do this episode, and we're looking at it, we reordered them, but the final two questions begged we should do another episode on those questions. So the lead in is perfect because of the fact that this picks up really with the last question of how does taxes affect my investments. What we're going to do is looks like a lot of questions that are similar. So Let's go from there. You ready?
Absolutely.
All right, perfect. All right. So the first question is, I love it. How can I minimize my taxes while maximizing my investments? You know what it reminds me of? It reminds me of the question we always get.
How can I get a low risk investment with a really high rate of return?
How'd you know that was my question?
Because we get it a lot.
Because we get it a lot. Yeah, I want a high rate of return with no risk. I'm like, yeah, okay. There's that unicorn, right? But anyway, how can I minimize my taxes while maximizing my investments? Well,
I would start by leading with investing in the right type of account with the correct asset allocation per account. I'm going to start by using something we've seen more recently that has really been driving me up a wall. You can invest in retirement accounts that if you don't know better, if you don't know really how they work, it can lead to many, many thousands of dollars of extra taxes that you have to pay, or ideally that you save because you invested in the correct type of account. The type of account that I'm referring to that drives a thorn up my side is an after-tax 401k. We have seen people put money into a 401k, contribute to it on an after-tax basis, which means you do not get the tax deduction for what you contribute, and any of your growth you have to pay taxes on. Now, how does that differ from a Roth IRA or Roth 401k? If you put money in, you don't get a tax deduction all the same, but you don't pay taxes on the growth. Would you rather pay taxes on the growth of your investment account or not?
No.
Okay. All right. I wasn't sure which way you'd go there. So we've had clients come who
huge,
massive amounts of after-tax 401k monies that if it was you click one different button, you have the same amount of money, but you saved yourself hundreds of thousands of dollars of taxes. That is the most egregious example of that, where it's just the type of account you put your money into could be the exact same type of investments, but how much you pay in taxes at the end of it can be very, very different. Now, if I could tackle the asset allocation part of it.
Let's go back to that.
Go ahead.
So we ran into it 3 times in the last month.
Yes.
And happened to coincidentally all be with the same company.
I had another one too, yeah.
Oh, did you?
Yeah.
There was 4 then.
Yep.
So back before Roth IRAs were in play, or Roth 401ks were in play, they gave you the ability to contribute to after tax. Or people would contribute to after tax once they exceeded the limit of their 401k allowable deductions. Well, in the one particular case, we saw that their after tax 401k value was about $500,000. And when we looked at it under the hood, we found out that their cost basis was $200,000, which means, to Kyle's point, is when eventually they take out that $300,000 growth is taxable as ordinary income. Okay, that is absolutely going to have about $100,000 worth of tax on it. Okay. Meanwhile, if that same individual all that time was contributing that 200,000 to the Roth, the entire 500,000 would be tax free. So, to your point, would you rather pay taxes on that 300 grand or not pay taxes? My recommendation, as well as Kyle's right now, is if you have a 401k and if you ever had after tax, you got to go look and see if it's there, because it's going to be different than Roth, because you're going to see after tax versus Roth. And a lot of people may have inadvertently, even today, inadvertently thinking that Roth is after tax, contributing to the after tax 401k. Giant mistake.
Yeah, and we got to write a letter to some board to fix that option.
Right,
It really
exactly.
It shouldn't be an option. I can't think of the positive impact of it. Anything else in terms of what type of account before we get to asset allocation there?
Well, I mean, obviously, we talked about, and this is one of the things that we've done before, and I thought you were going to lead into this before the asset allocation, and maybe you are, is when you're dealing with regular investment, non-qualified investment accounts, we always got to remember whatever your dividends and your interest and your gains and everything else are showing up on your tax return in that year. If you sold it, it may not be until the year that you sell it. Okay, but you treat accounts there and your investments there differently than how you treat your IRAs and your your traditional 401k, traditional IRA, Roth 401k, Roth IRA. You treat them differently, and I'll use the perfect example as bonds. Okay, bonds are going to distribute tax as ordinary income. The bad place for bonds of the three is in your regular investment account. Again, it's not bad, it's just that it's being taxed as ordinary income. And oftentimes what we do is we look at everybody's big picture allocation, and we look at their Roth, their pre-tax, and their non-qualified to give a big balance, but then try to fix things around to maximize tax efficiency.
Yeah, and there's a lot of different ways that you can allocate your assets accordingly to make sure you're paying less taxes over time while maximizing your investments. One area that I think is probably the most important is going back to the type of account you're contributing into. It's hard to project this out, but you can understand what tax bracket you are in today. It's harder to project out what tax bracket you'll be in retirement. Not so much retirement, when you're taking distributions of your retirement accounts, all right? So if you live in a high tax state and you're making a lot of money, we've got viewers all over the country. If you're in California, if you're in New York, you're making a lot of money. You're in the 32% plus federal tax bracket. Probably projecting out that traditionally thinking, I'm earning a lot of money today in retirement, I'm probably not going to be earning as much money. You might want to contribute to pre-tax accounts. All right, so that you save taxes today, you save it on a higher tax rate today, and you pay it on a lower tax rate in the future. A lot of people traditionally think that's the case for them, but a lot of people also, and we've had 1,000 episodes on this, where we could talk about Roth versus pre-tax, where it all comes down to your tax bracket today versus your tax bracket in retirement. If you have lower taxes today than you will in retirement, you are going to want to go to the Roth, right? Pay your tax today so you don't have to pay it in the future, and vice versa. That is probably the most impactful thing you can do to save tax monies over your lifetime on just the basis of normal, where am I contributing?
Right, exactly. And so going back to the actual investments,
Yes.
so, one of the other ways to minimize or maximize tax efficiency, let's focus on the non-qualified investment account. We said in a prior episode that the difference of taxation between a long-term capital gain and a short-term capital gain is one is taxed at ordinary income, the other one's taxed at preferred. So the preferred tax is always lower than the ordinary income tax unless they're both zero. But no matter what, if you're in a 10 or 12% ordinary income tax rate, it's a 0% capital gains rate. If you're in a 22, 24, or 32% ordinary tax rate, it's 15. Or if you're at 37, it's 20. No matter how you shake it, your long-term capital gain is always going to be lower than your short-term capital gain. So you take that into consideration when it comes to if you're 10 months or 11 months on holding an investment and you're thinking of selling it, unless there's very real reason that you need to sell it now, you might want to wait until after you're at 1 year.
Yes.
So that you can get the long-term capital gain treatment.
Yes.
Taking also into effect short-term losses or short-term gains. You always really want to know and understand what your realized capital gains and losses are in a particular year, as well as factoring in, do I have carryover losses from prior years of taxes? So there's a lot of tax planning that goes with your investments, which is why we do a lot of investing in portfolio models, which allows us to be able to scale a lot of accounts, because we're in a retirement account. If you buy or sell an investment inside an IRA or a Roth IRA or your 401k, and there's a capital gain, it doesn't count. Capital loss, it doesn't count. Retirement accounts only view taxes when you withdraw the money. Okay? Whereas a regular investment account, a non-qualified investment account, it's any transaction, a sale, is what they view as to whether or not what is the tax impact. So how we handle our investments is we do everything that are in the non-qualified investment accounts manually. And what do I mean by that? We never sell an investment. We never sell an investment without knowing, is it at a gain? Is it at a loss? Is it at a short-term gain? Is it at a short-term loss? Are there other investments that are at gains or losses that are going to impact this one? And are there any carryover losses from prior years that could carry over and offset gains? So as you can see, is there a way to maximize efficiency? Absolutely. Kyle was pointing out the difference between the registration type of accounts, pre-tax, Roth IRA. What we're talking about is in the non-qualified investment accounts, all of the things that you need to take into consideration as to maximizing tax efficiency.
Let's take it to our last episode. Let's take the exact same chain that you just went through. Dividends, everything. What if they have capital gain distributions, right? Certain funds, not stocks, certain funds will actually, if they have a really good year, they'll distribute a capital gain to you, short or long term. You have to plan around that. It could also distribute losses to you. Now, in terms of, yes, and not a mutual fund, but if you're looking at going back to mutual funds versus ETFs in a non-qualified account, we tend to lean toward ETFs. ETFs are less likely to have a capital gain distribution at the end of the year, whereas mutual funds are more likely to do it, meaning you buy a mutual fund January 1st and it comes out and it's December 20th and it's had a really good year. You got a 40% growth hypothetically, and it's going to say, okay, we are distributing a short-term capital gain of 30%. You're happy you got a 40% gain, but you're in a rock and a hard place. Do I sell the fund and capture a 40% short-term capital gain, or do I just take the 30% capital gain that's coming either way, if I don't sell it? There's a lot of tax ramifications that can come with what type of investments you own within your non-qualified account as well.
All right, so thanks for stealing my thunder. So he is exactly, believe it or not, explaining an exact investment that I had in 2017. To back up, mutual funds are required. They're required to take all capital gains that were made during the course of the year must be distributed to all of the shareholders. Okay, it's a law. All right, ETFs somehow can escape that. So what I had coincidentally happened to me in 2017 is in January, I bought this technology fund. This technology fund was up 50%. But then I learned that particular technology fund early December was distributing a 35% short-term capital gain.
My numbers were close.
They were close. So in fact, I was thrust into that position. If I had that mutual fund at a long-term capital gain at 50%, I'd have taken it, because I would rather pay a 15% capital gain on the 50% than a short-term capital gain on the 35%. But I was handcuffed because we bought it in January and now it's in December. If I sold it, I'm taking a 50% short-term capital gain. I took it in the shorts by being forced to take. And that, by the way, is why we use ETFs in non-qualified investments, except for bonds.
Yes.
The reality of it is that bonds generally do not distribute capital gains because they don't have that kind of fluctuation.
No.
So we'll use bonds because mutual funds and active management is usually
going to have those trading gains
And not only that, they're typically going to be better than passive
Yeah.
funds when it comes to bonds.
The last thing I'd add before we go to break is when you look at your net worth and your investment allocation, it's important not to just look at it in an account by account basis. You really want to look at the whole
Right.
aggregate picture. Because if you're looking, you have a Roth IRA, you have a traditional IRA, and you have a non-qualified account. You're going to want to balance those differently based on your risk tolerance and time horizon. If you're young, you're 20, 30, 40s, you got plenty of time for your retirement accounts, but you still want to have some bond exposure. You want to take all that equity risk. You might have most of your stocks, your equities live in your Roth IRA and have some of your taxable bonds live in your IRA, because if you're going to have one account grow, you're going to have to be the tax-free one, the Roth, right? Whereas in your non-qualified account, you don't want to have taxable bonds there depending on your tax bracket. We typically recommend people have municipal bonds, which means that you don't pay federal taxes. Take it a step further. We have clients in California, New York, high tax states. If you're going to go buy a municipal bond, go buy one from your state so you don't have to pay state taxes on that as well. So there's a lot of ways that within your investment accounts, don't look at them individually. You want to look at them as a whole and how you can best allocate them for tax efficiency over your lifetime.
So that's a great point. And what municipal bonds provide tax-free interest. And
Tax exempt is the
right, tax exempt. Well, yeah, same thing. So you want to look at what your tax bracket is and then take into consideration tax efficient yield. Or tax effective yield. One of the things is the immediate knee-jerk reaction is, yeah, man,
I won't pay taxes.
I don't want to pay taxes. But guess what? The municipal bonds know that and they distribute a lower rate.
Yes.
So rule of thumb, which is a fair lousy thing, is you might get 4% from a taxable bond. You pay 25% tax. What's your net? You netted 3. Well, then they'll give you 3% for a tax-free municipal bond. However, this is where we really dive down deeper into it, and we take a look at what your federal tax is, your state tax is, your effective tax. Okay, what is your tax on that investment if it was a regular bond? And we'll say, what is the tax effective yield afterwards? And then we'll take a look at the muni, and if the tax-free yield is higher than the tax effective yield, we'll take it. We'll do it. And it's remarkable. We're looking at, and we're doing a lot of this with a particular ultra short municipal bond investment, behaves not much different than money market. And we've been looking at it as an alternative to money market, whereas its yield after tax is less than what people are getting in a regular money market, and certainly what they're getting at their banks.
Yep.
So we'll stop there because here we go again. One question, an entire segment. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're going to pick up. We only got one question done in the first one, but that's okay. So the next question is, what are tax-deferred investments versus tax-free investments, or tax-deferred versus tax-free investment accounts? And that's basically the difference between an IRA and a Roth IRA.
Yes. You could, I suppose, include insurance?
Non-qualified annuities?
Well, yeah, like life insurance. Well, I'm thinking life insurance is a tax.
Yeah, I wouldn't go
Yeah,
there.
it's
Leave
tricky.
that alone. Actually, tax deferred is referred to as I'm kicking the can down the road because I'm paying taxes later, which was really designed to be for 401ks, pre-tax, as well as tax deferred annuities.
Mm-hmm.
Okay, tax deferred non-qualified annuities. You might put $10,000 in. You're deferring the taxation on the growth.
Yep.
On a 401k and an IRA, you're deferring the tax on the growth.
Yep.
What they mean by tax-free is the Roth IRA, you put in there all of the growth grows tax-free, but you must meet a couple requirements.
Yes, and just to be very technical about it, you have to have paid taxes on the money for it to be in the Roth so that you can receive tax-free growth and distributions.
It's after-tax money. When you say it, and just so that it's a misnomer out there. People think, well, I'm going to put money into my Roth IRA. I'm getting double taxed on it.
Yeah.
No. You're just taking regular after-tax money and putting it in there. So the misnomer, and I've had this so many times, and I want to make it clear here, is again, I don't want to pay tax twice on my money. They feel as though they're taking their $7,000 from their checking account, putting it into the Roth and having to pay taxes on that $7,000. That is not true. You're putting the money in because it's already been taxed. And then all of the growth is tax-free, but you need to meet the two criteria. The two criteria for a tax-free growth is you must be over 59 and a half years old.
Well, that number we don't know.
Yeah, I know. And it must have also originated, the Roth IRA must have been started and funded for at least 5 years. So if that's the case, then you get tax-free growth.
Yeah. Yeah, I guess the plain difference, what's the difference? It's when you pay your tax.
Right. And whether you pay tax.
Ah, there you go. Yeah.
All right. Next one. Oh, okay. This is what we were talking about earlier. Should I consider tax loss harvesting in my portfolio?
Depending on the type of account. So tax loss harvesting is in reference to when you invest something, it is at a loss, you sell it at a loss, and you are able to harvest the tax loss. What does that mean? You buy an investment for $5,000, you sell it for $3,000. You lost $2,000. Now, if you do that in a retirement account, it doesn't mean anything. You can't write that loss off. If you do that in a non-qualified investment account, a brokerage account, you will be able to write that loss off against your income. Now, if you sell, like I said, if you have a $2,000 loss, let's say you make $100,000, you're going to be able to write $2,000 off of your income. That's always recommended. Yes, it's not, I can't always say always, but yes, tax loss harvesting is a very, very powerful strategy that you can use. You buy an investment, $5,000, goes down to $3,000, you sell it, you'll have a $2,000 loss. One thing to be really, really careful of is what's referred to as a wash sale rule. If you sell something for a loss and you repurchase it within 30 days, 31? 30 days, you don't get to write off that loss because they don't want you to just sell something for a loss and then buy it right back and then get the growth. You have to wait 30 days to avoid a wash sale rule on your loss. So if you sell something at a loss, you can, and you really want to invest the money, go buy a similar type of investment so you can remain, get the same type of exposure, but at least you get the tax advantage today of writing it off. You can only write off up to $3,000 of losses in a given year, though, before you have to carry it forward. So sometimes what we'll do is someone will have, they'll get a bunch of investment income, they'll sell a lot of capital gains. Well, we want to offset that, and we can go through and sell some things that are losses to mitigate that tax impact.
So there's a lot of different things that happen here. So first of all, what happens is, I'm going to talk Fed here, okay? Fed is the most important one, but I do want to talk about Pennsylvania as well. I mean, we're residents of Pennsylvania, even though these are broadcast nationally. You got to take a look at your own state tax. But when it comes to Fed, and we do this all the time, again, it's when we're managing accounts and or when a client has already done something at an account held elsewhere. So tax loss harvesting may be oftentimes to offset gains that you already have, okay? So what I'll do is I'll take a look at what are their gains. Are they short-term? Are they long-term? And then I'll take a look at their account and say, can I offset immediately? I want to try to offset the short-term gains because it's going to be taxed as ordinary income. And to Kyle's point, you can only write off up to $3,000. So what happens here is, let's say I have $7,000 worth of gains in my account, and I have an investment that has a $10,000 loss. Well, I could take that $10,000 loss. That $10,000 loss offsets the $7,000 in gains, and then I put $3,000 on my tax return as a loss. And the beauty of it is it goes against my ordinary income. So if I happen to be in a 24% income tax, I'm getting a deduction at 24%.
It's a nice glass half full way of looking at losing money.
Right.
Get to write it off.
You play that game. So here's what I am cautious about, okay, so let's say I have a $20,000 loss. If I have a $20,000 loss against my $7,000 gain, Great. I now net have a $13,000 loss. I only get to write $3,000 off against my Fed tax, but I carry over the other 10. Here's the problem with Pennsylvania, and depending on your state, it could apply to you. I can't carry over losses. I can't write off losses in Pennsylvania. So I'm going to look at it and say, well, geez, if this is December and I wanted to take that $20,000 loss and I'm in Pennsylvania and it doesn't matter, I'm only doing it for the sake of tax loss harvesting, I'm only going to take enough to create a $3,000 loss.
Yep.
And then I'll take the rest in January because that loss can then be offset against gains in the following year that would otherwise be taxed in Pennsylvania.
Yeah, Pennsylvania gets you. They'll tax you on the gains. They won't let you write off the losses.
That's right. So you got to play that game as well. But it's also understanding, what you have for gains and what you have for losses. And by the way, to Kyle's point of the wash sale only applies to losses. And I've done this before. I've done this a bunch of times before. No one's ever heard of this besides me. I've harvested gains. Like, who in their right mind would harvest gains? This guy right here, okay? Why would you harvest gains? Well, I've got somebody who has a lot of capital gains, but coincidentally, this year they're in a low tax bracket, where if they're in the 10 to 12% tax bracket, they pay my favorite tax rate on capital gains. What's my favorite tax rate, Kyle?
Probably less than 1.
0, exactly. So what I'll do is if the person has $40,000 worth of room that they could take capital gains and pay no federal income tax, I will literally sell the investment, take the gain, and rebuy the investment. I've actually done it with a mutual fund same day, which you can do.
Yep.
So I had a technology fund. I said, look, I could take $40,000 in gains this year and pay no tax. I took the $40,000 in gains, sold it, and bought it in the same day. Okay, so what ends up effectively happening is I reduced my embedded gains by $40,000. So let's say, for instance, I had a total of $60,000 in gains, and I just took $40,000 of it. I reset, and now I have only $20,000 in gains in my investment.
Yep.
So if one time later I decide to sell my investments, guess what? Now I'm selling at a much lower. Or if the investment goes down a little bit, that $40,000 I reinvested is at a loss, and I take the loss the following year.
Yep.
That's being creative.
Those who know the rules of the game tend to play the game better.
That's correct. That's correct. Okay, and we have fun with it.
Yes.
There's nothing more than.
That's a pretty good segue into our last one here, too.
What is the next question? What is a capital gains tax? Is that the one?
Yep.
What is capital gains tax, and how does it apply to my investments? Well, we've been talking about that all the time.
Yep. Only applies to your non-qualified accounts. You don't pay capital gains tax in a tax-deferred vehicle, such as an IRA, traditional IRA, or 401k. And you don't pay capital gains tax in any other retirement account. So it's really just your non-qualified account. You sell something at a gain, you pay tax on it. How long have you held that for determines how much tax you pay, whether it's a long-term capital gain or a short-term capital gain. Same goes on the loss side. If you have a loss, it'll be a short-term loss, a long-term loss. They cancel one another out. And that's effectively how it applies to your investments. It's not something that you change your investment strategy per se over. You always want to keep your same strategy the same in terms of what's your goal with your investments. You keep the risk tolerance, but there's a lot of things that you can do via tax loss harvesting, tax gain harvesting,
Right.
that you can use to mitigate your taxes over time.
Long and short of it, it's not how much you make, it's how much you keep. And if you can develop strategies that reduce the amount of taxes, then it increases the amount that you keep, which actually also increases your long-term rate of return.
Yeah. Capital gains tax, very quickly, because I know we're running out of time here. It applies to other types of investments. It's not just stocks and bonds. You sell your home, you sell a rental home, you sell it for more than you bought it for, you will pay capital gains tax. And long-term capital gain does apply there as well with rental properties. Your primary residence, right? If you live in your home, you could pay capital gains tax. Now, I'm not going to get into the caveats of that because we don't have time for it, but other assets that you sell or buy at a loss or a gain can have tax impacts for you as well.
Right. And we'll be quick about it. If you do sell your house, you do get, if you've lived there now at least 2 of the last 5 years, you get per person, per homeowner, being the two. You got a $250,000 capital gain exclusion, and if you're married, it's obviously $500,000. So if you bought a $300,000 house and it grew to 500, 600, 700,000, you sell it. There's a $400,000 gain. But if you're married, you don't have to pay taxes on the gain.
I love the question of when people say, how much taxes would I have to pay when I sell my house? I'm like, what's your favorite answer?
Yeah, right. Well, you got to know what the
Well, yeah.
So anyway, we talked about it. What ended up happening is that we talked a lot about the gains and the taxes associated with investments. What we're going to do, and we still have more questions. We're going to do is we're going to kick it out to another episode, because what it starts talking about is more long-term. What you touched upon earlier on in the episode was, which do I go for? Traditional, Roth. How does my tax bracket today impact me later? How do my investments today impact me later? That's a greater and bigger tax planning question, which we're going to save for the next episode. So thank you for joining us. I hope you had a good time. I hope you learned something, and we'll see you next episode. Thank you for joining us.